Welcome to our Stearns Financial Group live chat. This morning we have a special topic. I'm joined by SFG's Financial Planning Manager, Tara Maxwell, to talk about Roth conversions. And this is an area that we spent a lot of time in the past going through different simulations with different clients on whether Roths would make sense or not. And generally speaking, a lot of those analyses said that Roths were maybe not as beneficial during life of our clients, but after death, passing assets to the next generation was where they would actually shine in terms of the paying tax early versus tax-free benefit. So that's really the key with Roth conversions is you are prepaying tax, which nobody likes to send a check to Washington or the state entities in advance, but you're prepaying tax in order to get tax-free forever. And so some things have changed. And if we could go to the next slide, right after that. So a couple things have changed that have made this topic a little more interesting or daunting or whatever you want to call it. Number one is the 2019 Secure Act. And for those of you who saw all of our special reports around the Secure Act, one of the key changes to it, other than making age 72 the minimum required distribution age for retirement plans instead of age 70 and a half, one of the other key provisions is that regular pre-tax IRA rollovers or retirement plans, when passed to the next generation, those heirs have to pull the money out within 10 years. And so that essentially accelerated the income tax. Prior to that, prior to the Secure Act, you could stretch it out over your lifetime. Your heirs could stretch it out over their lifetime and presumably pay in maybe lower tax brackets over some period of time. Accelerating it into 10 years for some people is a big game changer. And then the second change is the threat of higher personal tax rates. And here we say in 5 to 9 years, and some of you are thinking, well, if we get a political change, they're talking about changing the tax law in 2021. Yes, that's true, and we'll go through those tax rates. But here we're talking about even higher tax rates in the future that may be needed no matter who the administration is in order to pay off some future budget deficits. Now, again, we are not completely convinced that the rates that we have shown you in some past poolside chats and other material are going to come to pass, because there are 4 ways that the government can mitigate a future fiscal deficit and future debt. And tax increases are only one of the 4 ways, but it is an increasing risk, an increasing threat. And so we have done some pretty interesting modeling to help you understand some of that. So let's get on to the next slide. And Tara, walk us through, in today's environment, that key to Roth success.
Thank you, Dennis. So yes, we want to talk about what are some of the keys. And as we talk through this, we always want to think about individual situations and how does your individual situation look for the future to determine if a Roth could actually be successful for you. So first, we want to think about your personal desire to pass assets to a charity. So if we want to leave one of our beneficiaries as a charitable organization, we would not want to do a Roth because we don't want to prepay tax on something that they would never have to pay tax on. So this is a great asset a lot of times to leave to charity if you have an IRA that you want to leave a portion of or even all of, because you've not paid the tax on it, and once it goes to the charity, they also receive the benefit and don't pay the tax. So that's a number one consideration before we start looking at details of your personal situation. If that doesn't apply to you, we then really want to think about current and future tax brackets. And there's a lot that goes into that. So not only what's going to happen with future tax rates, are they going to go up? But would you actually remain in that same bracket? So we do have to think about that and how that changes over time. The other thing when we're thinking about tax brackets is a large or staggered conversion. So if we do too much of a conversion in a single year, again, we're going to raise our tax rates and raise our tax bracket. So a lot of times if there's a large amount that would desire to be converted, we would want to do that over several years so that we don't increase the rate that we're paying tax on those conversions. Another consideration for Roth Success, are you going to be subject to estate tax? And while currently the estate tax exemption for an individual is a little over 11.5 million, that could change in the future. But if you're subject to estate tax, it is often better to go ahead and pay the income tax before the estate tax calculation, so that the amount in that estate tax calculation is lower. So that's where a Roth could be beneficial. The other thing to consider is your inheritors tax bracket. So as Dennis mentioned that they now have 10 years to distribute accounts that they inherit, what's their tax bracket going to look like? And how is that going to change now that they only have 10 years to take the income from the IRA if it's left in the IRA? The next big consideration that we have to think about when we're thinking about a Roth conversion is your willingness to invest for growth in the Roth. And in just a little bit, we're going to look at an example to see how the return that you earn inside the Roth account can actually dramatically change how beneficial this is for you. And this is why earlier in the year, there was a lot of talk about Roth conversions, because during some parts of the year, our valuations were lower. And so there was a thought like, if the IRA account balance has declined, is that a good time to go ahead and convert it to the Roth? So that's something to take into account. The other thing we need to take into account is your personal financial independence margin of safety. And what that means is, what are your cash flow needs? Is the IRA account something that you're going to need to steadily depend upon to fund your expenses? Or do you have other assets to fund those expenses? So some individuals have a lot saved in retirement accounts, whereas other individuals might have smaller retirement account balances and assets in other types of investments. So that also applies to your ability to deplete tax-free resources to gain that tax-free status. And so when we do a Roth conversion, do you have outside accounts to pay the tax for the conversion? That's also another consideration that we need to think about.
Yeah, and that's something that we take pretty seriously, because particularly clients who have an overabundance of pre-tax retirement plans compared to after-tax monies, it becomes very awkward to replace a roof, for $10,000 if you have to pull out 15 or 20 from your IRA rollover, pay tax on it in the future. And so, looking at those after-tax resources is a key that you'd have to use to maximize the value of a Roth conversion. Now, the other thing that I'd like to just mention here, because I think it's really important when you're making a decision that has a long-term impact, is, do we think the Secure Act, just passed in 2019, will be around for the next 30 or 40 years? And, I'd probably bet a Krispy Kreme donut, or maybe more, that we are not going to see the Secure Act in place for 30 or 40 years. And we're going to be showing an analysis of somebody who's age 65, converting, and then living to an older age, and then passing it to children who have it for 10 years and pay tax on the Secure Act. Again, that's a big assumption that tax law changes stay the same. So even though some of the playing field has tilted in favor of Roth conversions, there are a number of things to think about. Let's go to the next slide. So the tax piece itself is a little bit daunting, and we went through some of these slides in a previous live chat and in a poolside chat where we talked about what's going to happen in 2026 when the current tax law is set to revert to the old tax law before the changes in 2017 actually took place in 2018. And so those old tax law brackets, the highest marginal tax rate does increase. Now note here, depends on your income. So they increase, the highest marginal rate increases 3% for 150,000 of income, but only 1% for 300. And so again, a little bit nuanced. And then for the highest or higher, because there actually is higher above 500,000, from 35 to 39.6. And so this is if the current tax law reverts in 2026, which is currently what's written into the law. Then the question is, what if we see a tax law change in 2021 as a result of a Democratic sweep of Congress and the presidency, and those tax law changes roughly equate to what you see on the screen. They're not exactly the same though. So again, we have a little bit of that short-term uncertainty. Now, where we really on the Roth are thinking longer term is the next slide. So the next slide, this is the estimates for, again, 5 to 9 years out, if tax rates have to go substantially higher than the reversion to the higher. So we've now got a two-step process. The first slide on taxes, we showed it going to the old higher rates. Now we're going to even higher rates to help pay off budget deficits in the future. Why 5 to 9 years? Well, first of all, Congress, and it seems like both parties are guilty of that these days, likes to kick the can down the road until it's really a critical problem. I think there was someone famous in history who said Americans do that in general, that we kick the can down the road. We're really good at solving the crisis, but we sometimes don't get ahead of the crisis. And so we're thinking that maybe these higher tax rates as a result of higher budget deficits, it'll be a Congress and president after the next presidential election. So in other words, 4 years from now, but really taking place 5 years from now, or the one after that, which it wouldn't surprise us if that can get kicked all the way down the road to 8 or 9 years out. And so these were numbers, again, we reported out on this in a previous chat. We had discussions with policymakers, we had discussions with tax professionals. What would tax rates need to go to, and not absolutely the highest rates would they need to go to, because I don't think anytime soon we're going back to 70% marginal rates like we had pre-Reagan in 1981. But what would they realistically, could they go to that would help pay off some of those deficits? And that's what you see on the screen. And as we've talked about in previous chats, it really, the 150,000 taxable income bracket, that one could be 25% to 30 instead of 35, because again, a lot of the new thinking here lately has been, let's let the middle class not have the brunt of some of these tax law changes. And so it could be more that 300,000 and 500,000 numbers that you see, where the 500,000 goes to 50%. And again, the Biden plan, some of the things trigger at 400, but then they really max out at 1 million or more. So chances are, whatever they come up with in the future will have 1 million or more tax bracket that could be even higher. So the bottom line of these tax rates is, we don't know if they're going to come to pass. We suspect some version of them may come to pass later on. And that's what we've tried to use in this latest simulation that we're going to show you in a minute. So let's go to the next slide. Oh, and this was something, Tara, you wanted to reinforce and double down on, because you've already mentioned it, but again, it is something people forget to think about. So go.
Yes, this is definitely something people forget to think about. There's lots of talk about tax rates and the probability of them going up, but we also have to think about where you are in your taxable income journey. And so over time, typically taxable income goes up, and then at some point it sometimes comes down. And so that's where we have to think about, is your situation based on your savings into retirement and non-retirement accounts? Is it actually going to cause you, when the IRA distributions would occur, to be in a significantly lower taxable income range? And if that's the case, even if rates go up, you may not experience much or any of that if your taxable income has dramatically gone down. So it's something that we really want to think through. But there are people who are in situations where they've saved significantly into the IRA accounts. And for those individuals, it's less likely that their tax bracket would dramatically go down. And so then when they see the increases, it would actually be an increase to their tax rate. So it's just a nuance that we have to think through with everyone. And I think that's the theme today, is that when we think about a Roth conversion, we really want to think about your individual situation.
Yeah, it's very popular right now in articles and other things coming out on this topic, that they say it's good in all cases. Well, I'm sorry. We've run a lot of simulations on this, and it's not good in all cases. And the point that Tara just made, again, I will triple down on that point, that those who have even larger retirement plan distributions, remember those required minimum distributions under the Secure Act, they may start at 72 now, but they still move up pretty rapidly into the 80s and 90s. And so you're talking about big ordinary income amounts of money that are coming in later on. So you really have to kind of run your own specific fact pattern to know where you stand on this. We have a question from the audience that apparently was a little confusing from the last slide, and that is that are you saying that Congress cannot raise taxes until after the reversion to old rates in 2026? No. Congress, if Congress is of one mind, which probably means of one party today, and not a split Republican Democrat, if Congress is of one mind, they can change the tax law in 2021. So they can undo what was done that reverts what called sunsetting and going back to the old rates in 2026. All right, let's move on to the next slide. Tara, walk us through the assumptions for these simulations.
So we're going to look at two simulations, and in all of the simulations, we're looking at a couple who is currently age 65. And so they have RMDs, or required minimum distributions, now beginning at their age 72 because they're under the Secure Act. They have the financial ability to not use this money that we're going to do the comparison on. So we're going to look at a $100,000 Roth conversion, and we're going to assume that they are able to continue to keep the money either in the Roth, or if it's in the IRA and they have to take money out, that they're able to keep it in another type of investment account. And so that is a big assumption here that shows the benefit of the Roth conversion in this example. We're going to assume that not only does the couple remain in the highest tax bracket, we're going to assume current law stays in effect so that they do go back to the sunset rates that we've talked about in 2026. And also, when they pass these assets down to their children, that their children are going to be in that highest tax rate. So that's going to kind of be our baseline example. And in the baseline, we're going to have the original IRA owner pass away at 85, but their spouse live another 10 years and get to treat that account as their own, and then they will receive it for the inheritor. So we're going to be looking at 30 or 40 years out when we look at these numbers. So on the next slide, we're going to see what happens if, one more slide, we're going to see if they have a 5% return forever. They're in this highest tax bracket. What you're seeing kind of in the middle of this slide is that the original owners age 95. So remember, this is 30 years out from now. They would have about an $81,000 benefit if they did the Roth conversion. And when we're calculating that benefit, what we're doing is we're assuming that they had to pay tax on the remaining IRA money and the money that's in that side account in that year, just to have an apples to apples comparison.
Yeah, and I think it's important to reinforce, you look at the chart, just the line one, and you say, oh, it's a benefit to me during my lifetime. Well, that's only if the existing IRA is all taxed at your death, which right now, even though the Secure Act has a 10-year rule, it could revert back to a stretch. It might not be taxed until the lifetime of your heir. So again, that 372 number versus 453 is for illustration, apples to apples, but I wouldn't take it to the bank because a lot can change between now and 30 years from now.
That's a great reminder. And the next thing I want to point out, if we look at the bold right below that, if we look another 10 years out and the heir is able to leave the money inside the Roth account, you can see that the benefit grows by a great amount to $187,000, almost $188,000. And the reason is that Roth money is able to stay in there and it's able to continue to grow tax-free for another 10 years. And they're not taking any distributions from that Roth account. And while that number is very large and seems very nice, we want to bring that back to what is that really worth today? And if we present value that, that's worth about $57,000 to the heir today.
Which, if you think about the fact that we started out with the assumption, maybe you've got $1 million in IRA rollovers, that 100,000 is a Roth conversion here. And so even in today's dollars, 57,000 as a benefit on a $100,000 Roth conversion is material. I mean, again, it's enough to make it interesting, but again, I think for a lot of people, they get focused on those future dollar values and they think, oh, wow, this is really phenomenal. Well, it's phenomenal if you have the right fact pattern. So that's where, Tara, you want to walk through our wild cards?
Yes, and that's a perfect reminder into our wild card. So our wild card number one is that this couple who's age 65, they went ahead and they did the Roth conversion this year. And then next year and for the remainder of their life, their income bracket actually drops down to be in the 25% rate instead of in the highest rate like we had originally projected for this couple. And so here we can see after the 40 years, so once the heirs had it their 10 years, the benefit is around $95,000 as compared to that $188,000. So that's where it goes back to the slide where we talked about understanding your future tax bracket is so important, because we don't know the exact reason in this example, but theirs went down and we can see it really dramatically decreases the benefit of that Roth conversion.
So this is a really important point to reinforce, because a lot of people say, well, tax rates have to go up. Probably, but the question is, will they go up for you? And will they go up for your unique set of income, pre-retirement, post-retirement? And the fact is that we see financial roadmaps all the time where tax rates aren't materially increasing over time just because of the unique nature and balance of their income stream. So here, with lower tax brackets during your life, not the heir's life, you've dropped the benefit in half of doing the Roth conversion.
And that leads us right into our second wild card. So our second wild card is the original owner and the original owner's spouse remain in that higher tax bracket. But when the heir inherits it, they're in the 25% bracket. And so here we can see if the heir's in a lower tax bracket, it does have an impact. It's not near as significant as the impact if the original owner was in that lower tax bracket. So here the value or the benefits around $155,000. So not as big of a challenge, but still a challenge in making sure that Roth conversion is right for you.
Yeah, and at the risk of, because we know some of our audience likes to just get the bottom line. We just gave you the bottom line, but we know some of you like to understand how the clock is made, not just hearing what the time is. So let's go back to the assumptions for a second, because there is one important piece in the prior slide, actually the one right after that, sorry, about the Roth conversion assumptions, and that is that we have a side fund. Okay, what does that mean? Well, if you have an existing IRA, you convert to a Roth, and in this case, again, we're assuming $100,000 of a traditional IRA is converted to a Roth, and you pay the tax from after-tax monies, not from the new IRA, which is the way that you maximize the benefit of a Roth. You have extra money you've depleted. We talked about that earlier in this discussion. And that extra money you depleted, if you just stayed where you were in your IRA, for $100,000, it's $42,000 or so, but it depends on your state tax bracket and a lot of other things. If you stayed with your IRA, you should still have a side fund that you would have used to pay the tax on the Roth that will grow over time. And so we've actually modeled that into this simulation, again, to keep it apples to apples. And again, for any of you who want to go through this analysis in the future for your personal situation, we can walk through some of that to give you a better idea of what it looks like. So let's go to slide 11. Yep. So now this is an interesting one, because we always tell people, if you're going to convert to a Roth and put this money in CDs, you probably just shot yourself in the foot. So the last slide was assuming 5% average returns over the next 40 years. And, that's just kind of a nod to the fact that at least near term, the next 5 years, maybe 10, we will have lower returns in bonds and other sorts of things. This says, okay, what if we took this $100,000, carved it aside, and thought about it as next generation money? So Tara, tell us about this slide.
Yeah, so those are exactly what's happening here. And so what we can see is the impact is significantly more. So on the last slide, the benefit of the Roth at the owner's age 95 was around $188,000. And here we have almost $280,000 of benefit, with everything being the same other than the investment return on the Roth and on the other accounts as well. So if we're able to earn that higher return, we see even greater impacts, because those returns are continuing to accumulate tax-free. And so that's where the numbers exponentially grow. And we can see here the benefit to the heir 10 years later. So we're looking 40 years out now, is $845,000, which is a significant benefit. Again, we can see in both the wild card scenarios that it does decrease the benefit. And again, if the original owner's tax bracket drops, that has the larger impact than the heir's tax bracket dropping. So it tells the same story, but it just shows how large these numbers really can grow to by just having a 3% return difference.
Yeah, so this gets back to your own financial independence roadmap. And would a Roth IRA be the dollars of last resort that you use later in your life to be able to help your expenses? Well, for some people that's true, and they can't afford to go to this more growth-oriented portfolio. We're assuming 10% return here on the growth portfolio over a long-term period of time. And right now, the place, I mean, there's been a lot of tech stocks that have done better than that, but that's only in the rear view mirror, and probably not going to do quite 10%, at least over the next 5 years. And so, you know, today, for example, our friends in the pension industry tell us that the number one asset that they look at for 10-year periods of time and longer to make 10% or more is at emerging market stocks. And oh, I was just reminded that we actually even knocked this down from 10 to 8, just to be a little bit more conservative. But you know, our friends in the pension industry say that emerging market stocks over a 10-year period of time, they're very volatile month to month, year to year, but over a 10-year period of time, and certainly over a 40-year period of time, could easily do 8% or 10% a year. But would you really want that in your retirement plan as last resort money? Now, if you can mentally carve it aside as an Explore fund for the next generation, different thought process. So again, I think this really highlights the fact that if you're willing to do more of a growth-oriented strategy, the Roth conversion can look even better. Let's go to the next slide. So this just kind of gives you a quick red light, yellow light, green light on whether you should even consider it. Again, very simplistic in some cases, but do you anticipate being in a much lower marginal tax bracket in the future? Well, we've shown that if it's more modest, that it's probably a red light, or maybe it's a break even. Will you die with a substantial charitable bequest? Tara started out with that as, you know, if you're going to make a charitable bequest of this particular $100,000, then maybe you don't want to prepay tax on it. The yellow light, meaning needs more run the numbers analysis, is do you need the IRA funds to meet annual living expenses? Do you have outside funds to pay tax on the conversion? We think that's one of the more important yellow lights. Can heirs wait 10 years after client's death to access the funds? We assume that they can let it ride for 10 years after you die. That isn't always the case. In fact, that's been our experience, that 40% of the time, you know, they need the money or some of the money to make ends meet in their own retirement plan. Do you have a long time horizon to let the funds grow? So here we had a long time horizon from age 65. If you're 75 or 85 or 95, this could be a very different analysis unless you're reasonably sure, based on family history and health, you're living to 100 or 120. And then the green light is, are you going to utilize your unified credit or generation skipping exemption with the IRA assets? Again, for many of our clients, this is not an applicable thing, but for our higher net worth clients, it is a very viable planning strategy. And then, do you have favorable tax attributes that can help offset the majority of the conversion income? And we've already talked about the possibility of tax rates increasing not once, but twice in the next decade, and making it have more favorable tax attributes. But again, just because the tax laws are changing doesn't mean that you personally have more favorable tax attributes or less favorable. You have to run the numbers. So going to the next slide, this is a little beyond the scope of our base analysis, but we wanted to make sure that our higher net worth clients had a little bit of a checklist for what to consider. Again, most of these things for folks who don't have the higher net worth are just not applicable. But there's a variety of these things that really need to be thought through for folks who have, I mean, at least 5, but 10 million or more, and certainly 20 million or more of net worth. These are things that are real critical in the analysis of, is a Roth conversion good or not? Now, we started into one of these analyses with one of our higher net worth clients recently, and after 10 minutes of discussion, he decided that I'm passing this to the charity because this is all way too complicated. Um, and the discussion was over. And so again, I think we go back to the original slide that Tara talked about. You know, what are your thought processes around all of this? How does it fit into your overall financial plan? So next slide. And that is it. I think okay, one other question, Tara, for you is if you did a financial plan a couple of years ago, are those projections still reasonable considering they don't include the Secure Act?
If they don't include the Secure Act, but they were done after the Tax Cuts and Jobs Act, so once we put our current income tax law into place, those are still relative because they are looking at during your lifetime. And so those numbers are still going to be accurate. They are not taking into account what happens to your heirs. We would have had those discussions when we went through it, but they don't actually model those numbers. So they are still relevant.
Okay, and we have another question. Do we already have a model for the Biden plan? So our existing financial roadmaps assume that the tax rates revert in 2026. But we currently don't have a Biden plan, mainly because the Biden plan itself is in a bit of flux and could easily change. And again, a reminder that Biden could win, but then the Senate has to go Democrat probably for any tax law change in 2021. So Tara, to what extent can we do what if scenarios around higher tax rates?
That is a good question, Dennis, and we have actually done a few of these. So what we do have the ability to do, and we work individually with every client on this, is we can add a percent of tax. And so we have run a couple where we've added 3% additional tax above what's scheduled to happen today. And we can make that happen immediately, or we can schedule the year when that starts.
Okay, very good. And again, customized because some of our clients are in higher brackets in retirement and some not.
Yes.
Yeah. All right. So an awful lot of variables here. Hopefully it wasn't thoroughly confusing. One of our 6 core values is making the complex simple. And as Tara and I have worked on this presentation, we realized, boy, this is a tough topic to make simple. I know that many of you record this and then watch it and fast forward and still shot. And so again, I think we've given you a few tools in here to think through your own situation. And as always, we're very happy to be able to help you figure out your own unique circumstances. With that, I would like to thank Tara, thank other members of our team who leaned in on a lot of this great analysis. And the session has been recorded, is available on our normal YouTube SFG channel. And look forward to talking to you about Roth conversions and other things in the near future.